Now, after a disastrous 2008, some hedge fund managers have been racking up big profits this year. And here with the details is markets reporter Adam Johnson. Adam?
Yeah, Matt, pretty interesting. Bloomberg tracks hundreds, if not thousands, of hedge funds worldwide. And the guys down at Princeton crunched the numbers for us over the weekend and tried to figure out where the best strategies scored. And guess what?
What?
There were some real standouts.
You've been hanging out with Courtney's friends down in Princeton.
Yeah, these guys are smart. They crunch the numbers. And what I'm about to tell you is unique to Bloomberg. No one else has done this work yet. Year to date, there were a couple of standouts. And, Matt, it was all about bonds. In fact, the top two performing strategies, nothing to do with equities. So, number one, 19.4% year-to-date return, directional bets on fixed income. Hedge funds are making directional bets in fixed income.
Everybody at the beginning of the year said short treasuries, it's the slam dunk investment of the year. I believe Mark Faber told me that, as well as 10 other guys.
Yep. Well, guess what? When everything imploded in March, bonds did too, and guys who bought bonds did extremely well. And it seems that's what a lot of these hedge funds did. They bought the bonds on the dip. As a matter of fact, we talk about ETFs, the HYG, the high yield index. That's up about 17%. Well, these guys are up more than that, 19.5%. So they did their job. All right, that was number one. Number two.
That's corporate debt, though, of course, that you're talking about. We have to distinguish that.
Yeah, absolutely right. Number two, mortgage-backed arbitrage.
Awesome.
Now, this is very interesting. I could understand, I think we could all understand mortgage-backed bonds, but mortgage-backed arbitrage, in other words, long something, short another, arbitrage tends to be much lower returns and much quieter, right, because there's a long against a short. So when you start seeing returns like that, it probably tells you there's some leverage in that system. But they were 18.5%. Number three, okay.
That's good, by the way, for Wall Street, right?
Oh, yeah.
Because
good for Wall
that
Street,
kind of thing
twice
creates
the commissions.
jobs.
Yeah, right. And what do they say? For every one Wall Street job, there are 8 other jobs in theory. I'd love to see that data, but that's what they say.
That's what we'll have them believe.
Now, okay, stocks, 10%. So hedge fund managers are finally beating the index. They're finally earning their 2 and 20 fees. 10.5%, all right, versus 4.5% for the S&P. Now, what were the worst? Asset-backed, all right, credit card receivables, auto receivables. Hedge funds that specialize in that lost about 6%. You say, well, why didn't they short them? Because those things all went down. You can't get a borrow on these things. They're very liquid, all right, very hard to do. And commodities, isn't that a surprise?
That's interesting.
Yeah, with crude back above $70, commodities CTAs, commodity-based hedge funds, lost 3.3% year-to-date. Very surprising.
We need to get a commodities hedge fund guy on and ask him what he was thinking at $33 a barrel.
Yeah, and remember, last year everything went down, but this year this differentiation, that means it's probably good.
All right, it's good for traders at least. It's good for Wall Street. Adam Johnson, thanks very much.